Well, it looks like that money printer is going to be turned back on. Is Powell pivoting? Is data really getting that much worse? But we really haven't seen it because the government shutdown, which is kind of crazy. We're in a shutdown, and I feel like nobody talks about it. Like the news has kind of forgotten about it. And we're on to the next topic, which is pretty typical in our world, right? But I was thinking about this the other day that it's pretty crazy that we were just data, rates, right? And what's Powell going to do? What's that going to do? And all of a sudden, like the government shuts down. We didn't get our jobs report. We didn't get an inflation report last week. Supposedly we're getting something this Friday, the PPI report. Maybe the government will be back open. Who knows? A deal will be made. Obviously, crazy times, so much stuff going on. But in my world, where we're just looking and, worried about the 10-year treasury, where's that every day? And what's going on with mortgage spreads? And what's going on with housing? What's going to factor in? What's Powell saying? What's he thinking? What's the forward guidance? When are we going to get the new Fed chairman? How's inflation? How's the consumer? How's the economy? How's GDP? All this stuff that's just hammering. It seems like for a minute, we've almost taken a break. I'm not saying we don't talk about it, but when it's not out there and there's not this like gun to our head that this is coming out the next week and this is coming out in 2 days and this is coming out in 3 weeks. In one way, it's kind of nice because it's not on there. The other way, it's a little bit scary because why is it not being talked about as much? Why is it not out there? But also too is when are we going to get the next data and what is that going to look like? And to be honest, do we still believe it or not? But regardless of all of that, life goes on, real estate goes on. As I say, real estate never sleeps. It's always going, always transacting. And whether you want to move on or not, it will move on with or without you. And these rates will continue to move on. But as we sit here in this government shutdown, which really has not really moved the needle on rates, the 10-year treasury, let's see, last time I checked, it did move under 4 this last year. As I'm sitting here talking to you guys, I might as well just pull it up and see where we got here for the 10-year treasury. The 10-year treasury, okay, so we are back over 4%. So in the high 3s to the low 4s, why did it go up? Why did it go down? There could be 9,000 reasons in today, right? It just doesn't matter. But today in this video, I wanted to talk about the money printer that's going to come back on, whether it's the end of this year or in 2026. You can see it. They're talking about it. You can feel it's happening, and most likely it is going to happen. But before we kind of get to the money printer, I think we need to go back over the last few years. How did we get here? For those of you that maybe have never listened to me or don't even know what the heck I'm talking about when I talk about a money printer, or you're trying to break this down, really for you, you might be, Kenny, I just want to buy a house. I just want to refi my house. I want to buy an investment property. I want to refi my investment properties. I just want to know what the hell is going on. What does this mean for rates? And that's why most of us care, because if you're in the real estate game, whether you just own a primary or you own an investment property, or you own tons of properties, you're trying to figure out what is going on, what's going to move the needle, and are they really going to turn that money printer back on? Is it going to be short-lived, long-lived, which nobody really knows, but I like to kind of go back and tell you how we got here, not going back 20 years, not going back 10 years, just kind of going back right before the pre-pandemic and walk you guys through quickly of how we got here. And that way we'll talk about where we're possibly going next, because as we always say, history tends to repeat itself. But by the way, if we've never met, my name is Kenny Simpson, and I focus on 1 to 4 unit financing. That means if you're trying to buy a primary single family house, or maybe all the way up to a 4-unit investment property, I can be your guy if that's what you'd want. I can, whether you're trying to refi, buy, whether you're a first-time home buyer, VA veteran, need an FHA loan, conventional, or you're a very complicated self-employed or real estate investor. Yes, that's me. Hi, my name is Kenny Simpson. Yes, like I just mentioned, I've been doing it 20 years, helped over 5,000 clients, fund billions of dollars of loans. And I shoot videos like this that you're watching to help educate you, to break down those crazy things you hear and see out there in our lovely world of craziness, and try to break it down in some normalcy, some normal level of what the hell everybody's talking about when it comes to rates, real estate, things like that. And today in this video, we were talking about the government, specifically the feds turning the money printer back on, which they had on, and then they turned off. And then they try to really turn it off, like kill us with the damn money printer. Kind of felt that way, right? And then now we're coming back. So how did we get here today? And I just want to go back. So if you go back to 2019, right before the pandemic, right before our world changed, right before our eyes, and they actually locked us down. And not here to talk about the pandemic, not here to talk about the lockdown. I'm here to talk about financially what that did to us as a world, as a nation, as individuals. And based on what we did at that time, what we thought was right, what you think was right or wrong or whatever, this is what happened. Now we're here left dealing with that. Some might call it a hangover. Some might call it the sugar high. Some might call it a disaster. But some of us just say, we're going to look at the data and we're going to tell you how we're looking the best we can. So 2019, coming up to the end of that year, rates actually were low. We were actually going through a refi boom, if you remember. 2018 rates were higher. 2019, we started seeing rates come down because if it wasn't for the pandemic, pretty confidently sure we're going to be entering some type of slowdown, recession, something going into 2020. But this little thing called COVID hit. And when it hit, it obviously shocked the world. And what it did is made us all slam on the brakes and stop and think about life and anything else for a moment. And that's what happened. So we stopped, slammed on the brakes. Pretty much life as we know it stopped. And what do? Well, we sat at home, and while usually our savings rates were around 5% and went to 35%. Credit card debt was at $1 trillion. It got paid down to $750 million. Good job, everybody. People were saving, people were not spending. Then you started realizing that real estate market kind of froze for 6 weeks. Yeah, it was about 6 weeks. People panicked, businesses shut down, couldn't work, the whole list, right? Boom, boom, boom. But financially, for a lot of people, it hurt. And then financially, for some other people, it didn't hurt. Because if you're getting paid, you stop spending money like you usually do. So you're stacking the cash, you're getting free money from the government. Maybe you were a business and you got money from the government as well, right? All that money got just trillions of dollars right in the beginning, went to businesses, went to people. Let's just say they pushed trillions of dollars into your bank account. Yes, trillions of dollars, as we said at home. And so when we're not doing our normal life, we're not spending money, we're saving, we're paying down debt. Great job, USA. When you go look at the stats, it's clear as day. It's crazy how we just made ourselves stop, which isn't a good thing. Like, doesn't make the economy work, doesn't make, businesses survive or us getting paid. So it's not a good thing, but it was just a thing where we actually stopped, paid down debt, and saved money. We actually stopped and had to think for a moment because we couldn't go do our normal crazy lives. We're stuck at home. And so that $2 trillion has turned into, from the pandemic, I don't know what it is, honestly. Is it 5 trillion, 6 trillion? But then from the financial crisis, when you roll all this in, it's somewhere about $9-10 trillion. They printed, they bought rates down, whatever you want to call it. $10 trillion went into the economy from the government. Just stop and think about how much money that is. Let's stop and think about the good that can do, the bad that could do. And then if you sit here now that we're approaching 2026, which the pandemic started, and I think it was Q1 of 2020. Yep, Q1 of 2020. We're going to be coming into our 6th year after. Think about all that money that just got printed in the last few years. Think about the pain. Think about the good. Think about the bad. Think about who got hurt, who got rewarded, whatever you want to think about. Just think about where we are now. And that's what I always tell people. You don't know this person that's running a company, this person that's in politically, this person that's the president, this person that is running your state, your local, whatever. You don't really know how people will do until you kind of get years out. Because in the moment, it could feel great. In the moment, it could feel bad, but then later on, you're like, was it worth it? For example, let's get into the nitty gritty. I already told you that obviously we were paying down debt. People had the average, 50% of the people or 60% of $500 in the bank account. Some of these people had $10,000 in their bank account. They never had so much money. So savings was high. They're paying down their credit card debt. They weren't spending crazy because they couldn't go out. We were trapped. Yes, they're ordering on Amazon. Yes, they're ordering food to go. Yes, you're buying stuff for your house or fixing up your house. Yes, people are refinancing at crazy low rates. Yes, people are pulling cash out refinances. Yes, people were buying investment properties. Yes, people were investing in buying in the stock market, at crypto, the whole thing. Yes, it was because we're sitting there again, doing things that we had time. We actually had time to sit here and think about, do we want to read? Do we want to get into running? Do we want to get into working out? Do we want to get into gardening, fixing your house, stock trading, crypto trading, start a business, right? Whatever, traveling, whatever you got into, you did. And based on where you're at now, your life might have changed, might have got better, might have got worse, whatever it is. But when it comes to money, when you print that much money, you're now left with, what do we do, right? And so when we look back, and for those that love the 1s and the 2s and the 3% rate, ask yourself a question. This is where you're at. Was it worth it? So the person that bought a house prior to 2020 that locked in a 2.5%, a 2% rate, that they have a house, their payment's $2,500, $1,500, $4,500, whatever it is, and you're locked in, you kept your job, you're stacking money, you're like, that was the best thing that ever happened. The people that bought a house at the peak and then maybe overpaid, maybe they're not. The person that bought an apartment building or investment property at the peak and got a low rate, but now that's underwater, it's not, whatever it is, it either worked for you or it didn't. That's what I'm talking about. But printing that much money obviously caused a lot of issues. Obviously, bubbles in real estate and crypto and AI and everything right now. Like, is it going to cause bubbles? Probably. How bad are the bubbles going to pop? We just don't know. But real estate's really screwed up, because when we go back to the one famous quote is, when we lowered rates that low, somebody at the Fed said we didn't realize what it would do, because you locked in 95% of the loans at the time were locked in at 5% or less, 75 or 4% or less, 30% at 3% or less, and they're on. So a lot of people out there, 42% of people that have no mortgage, the rest that have mortgages, probably a good slice of it are super low rates. And the rest are somewhat of a mixed bags of higher rates, medium rates, whatever. But you've locked in people who will never get out of that situation, or you lock people out that maybe never can get into this situation. So the reason why I'm saying all this is you have to look back, and that money that we printed, there's a reason why we printed it, because we thought we had to save the economy, save the stock market, save housing, bail people out, bail businesses out, bail individuals, whatever it is. Now we're here. It's 2026 approaching. Rates got low. They've kept them low way too long that we know. They should have started raising rates. And honestly, whether you like this or not, inflation started rearing its head actually much earlier than we thought. And so they should have started slowly raising rates, stop the money printer a year earlier. Slowly. If we would have done that, we probably wouldn't have needed to raise rates so high. So everybody's sitting here going, well, those low rates were so great. Now you're like, man, I guess I do wish we would have raised them slower, because we wouldn't be here, right? I don't know. This is the question we have to ask ourselves. But here we are again. We raise rates too high, slow things down too much. Now you have an unaffordable housing market. You got commercial that got crushed, right? Small businesses that lend got crushed. So inflation sky high. You gave all this money to people that went out and bought everything, right? Now people are locked into car payments they can't have. It's the whole thing. We all know it. You guys, if you're living it, you see it, you feel it, you talk about it, whatever. But that's not why I wanted to have this video. Today, this video, to wrap this up, because I wanted to talk about all that. Here we go again. Now we're ready to make another decision. And that's what this is about. It's making decisions. And this is a government that's going to make another decision. They're saying they're going to cut interest rates another 75 basis points or 100 basis points. And to get below that, we're going to have to see some major catastrophe. Is it another pandemic? Is it a war? Is it some crisis? Is it that the aliens are going to invade us? Is it that, something's going to blow up? Is it the GDP is going to blow up? Is the consumers going to stop spending money? Is it a recession? Whatever it is, it's always something that will cause us to go back to what is the most addictive thing that we're addicted to. Nope, it's not meth. No, it's not crack. No, it's not fentanyl. No, it's not. What we are addicted to, folks, as a society, especially in the US, is easy money, printing money, and giving out money at every single level. Everybody loves it because it's easy. And if you get easy money, it's nice. So when rates are low, it's easy. It's easy to make you and I seem like we're really good at buying real estate. It makes it easy to buy the deal. It makes it easy to build the deal. It makes it easy to lock in on the deal. It makes it easy to qualify for the deal, right? When rates are super low. But when rates come this high, buying that investment doesn't make sense. Building that investment doesn't make sense. Buying that house doesn't make sense. Refining the house doesn't make sense, right? There's all this stuff. So there's this balance to where we're dealing with a lot of it. It's like one way we go this way, the next year we go this way. It could be rates, it could be anything. So here we are again. Now the Fed's going to start cutting rates. And then there's the argument. We should have done this a while ago. The data is terrible. The housing market, there's all this data, right? We could sit here and list it all. Then there's this other side that says we should not cut rates. What do you mean there's problems in the jobs market? Employment rate's at 4.3%. That's super low. What do you mean the GDP is good? The consumer's doing good. Yeah, there's some problems, but it's nothing crazy. There's nothing falling off a cliff. There's no recession. There's no craziness going on. We do not need to print the money. We need to wait. And so that's the problem right now. You have two sides that are debating, and whether you do one thing or the other side's going to bitch about it and moan about it. But I made this video because the money printer as of now is going to come back on. They're going to drop rates 7,500 basis points. Interest rates, maybe a 30-year fixture you got quoted with 6.5, no points, 6.37 from no points, whatever it is. Maybe the 15 years in the 5s, maybe the VAs in the 5s, maybe ARMs in the 5s, whatever it is, whatever you got quoted, it's a rate of today, right? Depending on your scenario. That rate could be a point lower, could be a 1.5% lower. We just don't know. But what we do know is that now we are shifting. That shift, depending on the data, is going to go slower or faster. If the data gets worse that we can't get, and even if we get it, do we believe it? It is going to start coming out more and more. And this whole conversation right now that's about, the government shutdown or stopping wars or this or that, whatever the heck we're talking about. When it comes to rates, we're going to go back to the data. We're going to go back to this stuff. We're going to go back to the rate cuts. We're going to go back to housing affordability, to refi in the commercial markets, and to help the small business and the consumer and everybody, right? We're going to go back. But one thing that does not fix, it does not, our $38 trillion we're almost in debt, it doesn't touch that. It probably makes it worse, right? The housing deal that you might get today, if rates are 1.5 point lower, or is the housing going to go up? Is it going to go down? Depends. Are we going to get a lot more inventory? That should help. How about people are like, well, that's great. Rates are now in the mid 5s, but I got a rate that's 2.5. I'm not giving it up. I'm not selling. Well, that's great. Can he have a free and clear house and I'm 65, 70? I'm not selling. So are we always going to have an affordability crisis? Do we need to build more houses? Do we have enough houses? Is the 5, 6, 7 million dilapidated houses that are sitting out there that need to get fixed up? Could you incentivize people to fix them up and flip those and sell those? I don't know. But my point of this video, folks, is just kind of going through with you. I'm just talking how I think about this stuff, is that we are going to turn the money printer back on. We are going to lower rates. You are going to get to refi. You are going to get to buy. You're going to buy those investment properties. We're all going to, the small businesses can refi debt, and this will stimulate, and the companies might feel better about borrowing debt, and then, they can go hire more people, and then we're back in the cycle. How low will the rates go? I just don't know. There's people saying that they should cut rates to the 3.5%, and below that, there should be economic pain. There's people saying that their Feds should cut the rates to 2%. But we will watch the data. We'll continue to let you know about it, but we're just not going to know where we're going to land and if it's going to make sense or not. And that's really what's going to happen here is the money printer is back on, and we don't know how long it's going to last. So I will tell you this. Sorry for this all over video. I'm kind of sharing my thoughts today. I'm kind of thinking about how I think about this, and what's going to happen. It's just going to happen because that's life, because this is what happens. We do not know any other way but the way we're doing now. The cycle will continue because nobody's willing to do the hard, dirty, ugly work, which is really stop spending the money and go through the pain to stop this, because we don't have to yet, because the pain's not great enough, or the cause, if we keep going, hasn't hit us where it's gonna stop us in our tracks, like a COVID, like a pandemic. Meaning the pandemic, we had no choice but to shut down accordingly, right? That's what we did because we didn't know. There might be a point where we're gonna have to stop spending. We're gonna have to watch the budget. We're gonna have to pay down debt. We're gonna have to tax people because we cannot sustain this any longer. There might come that day in the 5, 10, 20 years if it doesn't get fixed, right? We all know that. Every politician or person knows that $38 trillion turns into 40, then 45, then 50. If we keep at this rate, then eventually we're all gonna have to sit here and go, how are we gonna pay that down? Unless somebody can do something crazy in this country, invent something where we could sell it to everybody, the 8 trillion people around the world, and make enough money to pay down the debt. Something like that, right? But look, there is going to be a time, I think, next year where rates are going to come down. Maybe they're going to come down lower than we think, maybe not as low as we think, whatever, to where you're going to have that opportunity to buy, refi, whatever it is. And so keep watching, because as we get closer and closer to that and closer to the data, hopefully we'll be able to time it Nothing you could time but say, hey, this seems like a really good spot to refi if you've been waiting. So anyways, thanks for watching, guys. That was it. The money printer, yes, is going to come back on. Whether you like it or not, it's coming to a theater near you. Keep watching. Share this video with somebody. Until next time, we'll talk soon.